welcome to the Altos Trading Live Strategy Session with Jeff Tompkins. This is your host, Richard Van Rich, and we have Craig Ward with us also in the chat. Hope you guys had a wonderful Labor Day, happy holiday weekend. Back in swing of things today. If this is your first time on one of our sessions, you'll notice our microphones are muted. That's so we can all hear Jeff and I talk. But there is a Q&A box, so if you have any questions throughout the evening, you can put it in the Q&A box, and we'll answer those throughout the night, and also before we sign off at the end. Awesome. So if you have to hop off for any reason, don't worry. This is recorded and will be available in the members area later tonight and sometime on YouTube tomorrow. So if you're following us on YouTube, please make sure you like and subscribe so you get all of our emails and videos that are coming out every single week. So let me read a disclaimer before I bring on Jeff. Altos Trading LLC and Trade Transilient software is intended to be used as information service for subscribers, and it includes opinion as to buying, selling, and holding various stocks and other securities. However, the publishers of Altos Trading / Trade Transilient software are not brokers or investment advisors and do not provide investment advice or recommendations direct to any particular subscriber or in view of the particular circumstance of any particular person. Altos Trading LLC, including its owners, do not accept responsibility for any decisions made by subscribers using the software. Subscribers to the Trade Transilient software or any other persons who buy, sell, or hold securities should do so with caution and consult with a broker or investment advisor before doing so. And speaking of subscribers to Trade Trend or Altos or anything through Zillion, if you have any questions about your subscription, access, anything like that, anything on your account, email support at Altos Trading, and we'll get to those personal questions tomorrow after the show. So with that being said, let me bring on Jeff. Jeff, if you're there.
Hello.
Hey.
Hey. Hope everybody had a good Labor Day weekend.
So what did you do? Did you guys go out of town?
No, we stayed in town. We attended a neighborhood barbecue, did some yard work, took a little break from the markets.
There you go.
It wasn't a bad thing.
How was the barbecue?
Great. Yeah, we have some new neighbors that just moved in across the street, so we got to spend a little time with them. And it's still hot here, though. It's like 103 or something like that. Almost a little over 100, I think, today. It was brutal. Yeah, outdoors.
So like in Idaho, like there's like regional barbecue, you know, in the States. What's like known for in your areas or anything in particular that stands out?
You know, we kind of get like a mix of like Texas barbecue and more like, you know, because I mean, true traditional barbecue is like smoked. You're not actually, you know, it's not like real barbecue. So we get, you know, some of the like standard like flipping burgers, you know, type of stuff too. But we don't really have any good as far as restaurants. They're just, it's not like Austin, you know, we don't have the great barbecue up here, but so we do our own.
I remember eating somewhere near your house. Last time I was up there, there was some place, it was in town. I think it was like Texas style, I think.
It might have been Texas Roadhouse. Was it Texas Roadhouse?
Not like this. Not like the steak place. I don't remember what it was called. It was like a independent place. It was kind of near.
Oh, it was it was Bodacious Pig.
Yeah, that's it.
Yeah, that is good barbecue. That's legit. That's good stuff.
Yeah, they have some good pulled pork there.
Yeah, they do. Yeah, we do a lot of our actually. So I've got a Traeger. I love the Traeger, and I did some beef ribs this weekend. Actually, yesterday. Yeah, we did Labor Day dinner at our house.
Was it like the big dino ribs or the?
Yeah, the big beef back ribs, and put a dry rub on them, and oh man.
Craig telling us to hurry up.
Craig's
like, shut up with all the barbecue talk. Get to trading.
Well, I haven't had dinner yet, so it's making it worse for me.
Yeah, I could tell that.
Probably hear my stomach growl here in a second.
Be ordering DoorDash.
Yeah. How about you guys? What'd you do this weekend?
What'd you do, Craig? You there?
Yeah, I did a lot of yard work. It rained a lot, though. I mean, I'm sure you're aware, but tried to get a lot done and did not accomplish all my tasks, as most people probably do on a holiday weekend. But yeah.
I took my daughter to the zoo yesterday.
The Atlanta Zoo?
Yeah. Wasn't that bad? You know, back in the day, you'd go to the zoo and the pandas were like orange and sitting in the dirt. And which is like a barely better than a petting zoo, but it's actually pretty decent now.
Oh, I haven't been there in probably 12 years.
It's no San Diego Zoo, but it's decent.
No giraffes.
There's some giraffes. They had giraffes, they had lions. They have a lot of giant gorillas and orangutans, and they do have a couple panda bears, actually.
Very cool.
They have
Yeah,
gorillas.
anyway. Yeah.
Very cool.
Yeah.
Well, good. Well, I hope everybody had a great Labor Day.
I'll edit all this out. Don't worry.
And Richard's goatee is back in full effect now.
It's so itchy, man. I gotta. I don't know. I don't know if it's gonna last the next week.
Yeah, we'll see you back with a baby face next Tuesday.
Smell like Bath and Body Works. I all this cream and crap on my face. It's not working.
Yeah.
The
All
itch is
right.
strong.
Well, yeah, again, welcome everybody. Thanks for being on. And obviously a shortened trading week this week with the Labor Day holiday yesterday. Markets opened up today, another down day. So we've now had 3 consecutive losing weeks on the major indices, and September tends to historically be a bit of a rough month. So we'll see how that pans out this month. And we'll talk about some of the catalysts behind what happened today and what's pushing the markets down currently. We'll map out our key levels and then review the 36-month moving average as it relates to the major indices and look at the VIX. And then follow up a little bit on our topic from last week, which was volatility expansion and using standard deviation bands to gauge that. What we discussed on our session last week is, playing out in between, the time that we first started analyzing that, because I believe it was kind of set in motion right around our meeting last Tuesday, and has played out as we warned on our last weekly session. So we'll take a look at that, and then we're gonna, because of that reason, we're going to build on what we talked about last week with volatility expansion, and then using probability analysis to help us spot potential turning points in these sell-off or vol expansion scenarios. So we're going to dig a little bit deeper into probabilities and how to use those to help plan our trades or investments. And then if we have time, we'll do our ticker roundtable and wrap up with Q&A. So a lot of stuff to cover tonight. A lot of good stuff, I think, that will help us in our trading week, albeit a shorter one. So let me flip my video off here and get over to our charts. So we'll start out by looking at the S&P 500 index on the daily. So again, last week we focused on volatility expansion, how to analyze that, and kind of the whole process of what leads up to it, and how to basically identify that. And then right now we're in the midst of a sell-off with the volatility expansion. So we have price trading kind of around a 2 standard deviation move from the mean. And what we talked about is when we see price continue to trail the lower 2 standard deviation band, it again in a volatility expansion scenario, we tend to see that continue for some time until prices get lower and demand exceeds supply and buyers come back in and push price back up. And so that's what will lead into our focus for tonight, which is looking at probabilities using options math to help us further identify those. In addition to the levels that we're going to map out here. So looking at support, and a timely topic for this week because we're trading down into some significant levels of support on the S&P. So if you look back at May, June, more so May, the lows of this year were hit in mid-June, but as we're in the Q1, Q2 of this year, and the S&P was trading at higher levels, and then coming down into this roughly 3880 support area. Again, also kind of more of a zone. So if we look at probably the more significant half century mark, right around 3850, you'll see we have this support zone that propelled prices higher on the S&P back in May, before a rotation lower and continuation of the broader sell-off. So we're now in that approaching that support zone currently, and it's in the context of the the volatility expansion. So again, we have a spike in volatility, which, as we'll look at in the VIX here shortly, coincides with a rising VIX. So we see price trailing the lower standard deviation band here, and these can create great buying opportunities when we spot areas of support where buyers may be coming in to push price back up. And if you'll recall, we look for price to return at a minimum back to the level of the volatility expansion where that initiated. And that's kind of right around the 40-50 level. So also something to take into consideration is we've broken a millennial mark on the S&P. So 4,000 was taken out last week. And that's significant. So when we break one of these millennial levels, it's often difficult for for the major indices to get back above. It takes quite a bit of buying and demand to get pumped into the market to propel prices higher, but it will occur. And so our job is to look for areas of demand, in other words, support levels. And then tonight we'll look at using probabilities in combination with that to spot potential reversals and rotations higher in the majors. So for this week, and largely what drove the sell-off after this 3-day weekend, we got ISM data this morning, and it came in stronger than expected. And of course, that followed the non-farm payroll release last Friday, which also beat Wall Street expectations. So we've got actually this really strong economic data coming out in the midst of high interest rates and a hawkish Fed. So it's creating a bit of a Jekyll and Hyde market. But ultimately, what happened today and why there was a lot of volatility, but the market sold off because the strong ISM data caused bond yields to rise, which then in turn caused equities prices to fall. So it was kind of a chain reaction there a little bit, but that's why we're seeing this sell-off, coming into the new trading week, from a continuation from the past few weeks. So we had a lot of clues to this. Obviously, we were at overextended, so we were trailing the 2 standard deviation band of the upside. We came into very strong resistance where there was a lot of prior selling from back in February and early May. Saw the same thing here, and then our algorithms obviously picked up a reversal in momentum, and we had this rotation lower, a sell signal, and this one's actually still an active signal. So entry kind of right around 42.50. Now our trailing stop algorithm is down around, looks like roughly 40.25, 40.30, with S&P trading on the close today at 39.08. So keep in mind that these century marks like 3,900 are psychologically important levels on the S&P and the NASDAQ. Also for tomorrow, watch 3900s because we just closed just above it at 3908 and change. So watch 3900 tomorrow and then watch the support zone. Let's see how price reacts. And then we're going to look at probabilities here in a second using options data that can also help us identify probabilities of trading around these levels and also reversing from them. So those are the big ones to watch for tomorrow and through the remainder of the week on the S&P. So again, this is our support zone where we have a greater likelihood of a potential reversal back up. We have strong resistance around the 4,000 level. We've also got, if we do get a bullish reversal off of the support zone, we've got some other resistance to contend with that's not really all that higher up from current levels, right around 3950. So these are some important areas to watch for resistance if we get a reversal. So we've had a significant sell-off, right, in August and into the start of September. And we'll look at the monthly chart with a 36-period average as well. But let's look at the NASDAQ here real quick. Again, we'll look at the NASDAQ 100 ETF, the Qs. So a similar scenario, we're getting this volatility expansion. And again, looks obviously very similar to the S&P. Also got a sell signal off a resistance area, and then we're getting this volatility expansion. So price is trailing the lower standard deviation band. So again, this is where a lot of traders and investors are panicking, unwinding positions, potentially there's, I'm sure, more shorts coming into the market, but eventually, right, this oversupply has to dry up and demand will eventually, it'll shift to a demand scenario where we'll have some buying opportunities. So we have a bit lower, I think, to go. Again, kind of more of a support zone here. So if you look at past areas where price has reversed or traded below and found resistance, this zone here is kind of our area of support. So like the S&P, we're just kind of coming down into this area where we have a decent chance of seeing some degree of a reversal. And if that occurs, we ultimately expect price to return back up. So right around the 310 level, where the volatility expansion began. So if we do get, again, like the S&P, if we get a reversal off of this support zone here this week, and if these occur, we'll likely see them happen this week. I mean, short trading week, we've only got 3 more days in the week, but since we are so close to these demand zones, I think that there's a good chance that could happen. And the ISM data is out. It's kind of passed, and it's built into current pricing at this point. So it's just the continued fear of the hawkish Fed and inflation. So those are the catalysts. So we've got, if we, like the S&P, if we get this reversal off the support zone, we do have some nearby overhead resistance to contend with here. So again, this is our support zone. And this would be really our first significant level of resistance on the Qs.
So Jeff, like if somebody, let's say they didn't catch that sell, back towards the end of August, do you think they'd be waiting for at least this reaction before they try to take anything, because they've kind of missed the move, but you're not sure exactly where it's going to turn on? What do you think?
So at this point, like the short's already happened. You don't want to chase the market, right? It's already occurred. So The contrarian approach would be to, to wait for a reversal back to the upside. So these volatility expansions create really great opportunities if you know how to spot them and trade them. So we're that's why we're building on what we went over last week, which was how to identify these, and then we'll go into kind of how to navigate them as we come into these areas of support and prior rotations from a sell-off or a volatility expansion to the downside, back up. And we can look at some other past examples too, just to clarify that if you weren't in attendance last week. So I think we're kind of coming down into an area where that's a greater possibility now. Yeah, absolutely. So let's look at the VIX and see what the VIX is telling us, because to reiterate what we've talked about in the past, we want to see the VIX retreat from a resistance area with its inverse correlation to the major indices, particularly the S&P. As for instance, the S&P is coming into a support zone or area, we want to see the VIX rejecting a resistance area and retreating, because that's when we tend to see a reversal off these volatility expansions. So as we were noticing the price on the S&P and the NASDAQ trailing the lower volatility band, or the 2 standard deviation move from the average, what we'd expect to see is the VIX spiking, right? And let me actually zoom out a little bit more here. So the next step is we want to look for volatility resistance on the VIX, and we want to see that hold and then have the VIX retreat back down. And so when we see that happen around the same time that we're hitting a support zone on the S&P and the NASDAQ, in addition to, again, what we'll talk about in more detail tonight with probability analysis, that's a really effective tool for giving us a broader perspective of what's going on in the overall markets, and then of course can help us plan individual trades and make better trading and investment decisions. So we do have this significant resistance area on the VIX around 28. It's so far, as volatility spiked, and we've seen the volatility expansion and subsequent sell-off in the major indices, you'll notice we have all this consolidation here on the VIX. So the VIX ranges are still wide. So we're seeing high volatility intraday. So if you look at the high and low of the VIX intraday, it's still relatively high. You tend to see tighter ranges down at lower VIX levels. But what we're noticing is that there's this consolidation and rejection of resistance on the VIX around 28. So when you see the VIX start to consolidate and resist a level, it's a greater likelihood that you'll see a reversal in the major indices back to the upside. So this is kind of telling us the story that there's still high volatility in the markets, but it may be losing steam, which again, because it's inversely correlated, can give us advanced warning of a move up in the major indices. So that's kind of what I'm expecting. So we just want to keep an eye on this and actually see the VIX start to make lower closes, because right now we're still in consolidation around this resistance level. But all this tied together, the confluence of all these variables is painting a picture that there's a pending reversal back to the upside. So this is really the only level I'm watching right now on the VIX, right around 28. And that could change if we get a close above the 28 level, or if we get really any close above these previous spikes. And and then we break through those support levels we just mapped out on the NASDAQ and S&P. That would be our indication that it's too early to jump in. The market's not done selling off. So we want to watch these closely, particularly this week, because we are at these potential inflection points on the indices and the VIX. Okay, so let's also look, and then we'll open it up for questions if you guys have any questions on this. Let's also look at the monthly chart of the S&P and the NASDAQ. So we spent a lot of time talking about the 36 period moving average and how historically that's tends to create a lot of buyers coming into the market around that level. And you can see from past market corrections or market crashes, like here in early 2020, or bear markets like this year, we tend to find a lot of support around the 36-month moving average. So that's why we watch this so closely. It's closely followed by institutions, hedge funds, and money managers. So this is more of a medium to long-term analysis, but we're actually going to use this on our probability analysis tonight. So right now, the dynamic support or the 36-month moving average is right around 3,800, a century mark on the S&P. So we could find more support there if the sell-off continues. We've already obviously, encountered this moving average on 2 subsequent months, right? So June and July. And we got a bullish move off in July, but then August, we get the big bearish reversal. So it may not be over, but we're likely to continue to find some support around 3,800 if we get down to that level. So that's why I'm saying watch 3,900 really closely, because if we break lower, then we're going to have a higher likelihood of coming back into this 3,800 level. And then on the NASDAQ, we're actually back down below. So if we look at the NASDAQ index, we're now trading below, but we didn't get a close below in August, but we got a gap down and open below. So obviously this month is still to be determined, but we are trading below the 36-month moving average. So if we get a close on the NASDAQ below this level this month, after we already had a bullish reversal in July, back to the upside, that's going to provide more of a bearish bias. And we're going to want to be really careful, especially in the tech sector, with a continuation of bear market conditions. So we'll also be watching this one. And it's kind of unusual to see, at least a series of monthly closes below the 36 period moving average on like one index like the NASDAQ, while the S&P trades above. So they tend to kind of go in tandem as it relates to this. So it'll be interesting to see kind of what happens here. But we have more bearishness right now overall in the NASDAQ and the tech sector than we do in the S&Ps. Okay, so any questions there, Richard, or anything to clarify before we get into probability analysis?
No, this came in earlier, I think on one of the forums, but it asked about if you see any sort of like patterns or anything, like any like W patterns or anything forming on NASDAQ or the S&P.
Let's go back to the S&P chart.
Anything sticks out to you, or?
Yeah, I mean, as far as like overall broader patterns, we do have this and that's why this and right around 23. So again, this is on, oops, did I click on the wrong? Get out of this, sorry. To the S&P 500. So this 3,900 level, but more 3,800 to 3,900 zone is again important because we do have a pattern here where you often see, so you've got, it's kind of like an inverted head and shoulders, I guess you would call it, but you've got on the left here, you have, a prior sell-off, a rebound to the upside, continuation of the sell-off. So then you hit, and these are again the lows from mid-June. Then you get, buyers come in pushing prices higher, and often you'll come back up or even exceed the previous swing high or a supply point from the left side of that move, and then coming back down into it again. So yeah, it is a bit of an inverted head and shoulders pattern. So and the reason that we looked at this support zone and looked at these levels as we're coming back down into that for this week. So I think that's why it's crucial to really watch to see whether buyers come in back at these levels as they did back in May. And then also, of course, with the volatility expansion that we've been looking at that we're currently in. So, I mean, that's really to me, the most obvious kind of pattern. I don't put a whole lot of weight in like broader chart patterns, but often when you analyze these supply and demand levels, you'll find they're within the context of a pattern, like a head and shoulders or inverted head and shoulders, or a double bottom, or all these different types of broader patterns. So yeah.
All right, that's all I got.
Okay, so so let's use the S&P because and what I'm going to cover, is can and should be done with individual equities or ETFs if they're optionable securities. In other words, they have options to trade on them, which is a tool we're going to kind of use to do some probability analysis around these more visual chart levels that we're mapping. So as we come, as we're coming down into an area of previous support that again previously attracted buyers into the market and pushed prices higher off of volatility expansion, and this is again a bit of a more complex and bigger example of a volatility expansion, but we had one back in April and in May and into June, right? So you'll see that, and they're nearly always preceded by a period of low volatility or a move up in the market. So we looked at this one last week, but just to recap, we have a volatility expansion of the upside. So prices trailing the 2 standard deviation upper band. And this looks similar to what happened here. It just wasn't, the previous one wasn't as extreme of a move up in the market, but very similar type of thing. And so the volatility expansion is typically followed by, or a sell-off volatility expansion is typically followed by a run up in the market, a contraction of volatility, and then followed by a volatility expansion. So again, what we're looking for is price to be moving at or exceeding a 2 standard deviation move from the mean as the outer volatility bands are diverging, and then price trailing the lower band. So this was a really big one. And of course, resulted in the lows on the S&P for the year back in mid-June. But you'll notice that price came back up to the level of the volatility expansion. Okay, so that's kind of what we look for here. And so that's, again, what we're in now. So the trick is, right, finding high probability areas for these types of reversals. And so we do that with prior levels of support in the case of a sell-off volatility expansion, but we can also use options probabilities to help us identify these types of zones and use them in combination with what we've done so far on our session tonight. The visual aspect of the chart analysis. So if we look at get this over to the other screen here. If we look at an options chain of the S&P. And we can pick obviously different time horizons, different expirations. So typically I want to look at more than one expiration, depending on the context of what's happening in the market I'm analyzing. So as we're looking, obviously at the S&P, and we're in a volatility expansion, and we're selling off into prior levels of support. So we're in close proximity to these levels. I'm going to want to look at short-term expirations to start looking at probabilities. So, if a level's a ways off, like if we wanted to look at probabilities down from lows in mid-June, we have a lot more distance to travel to get to that destination if it occurs. So you want to kind of choose your expiration for your probability analysis relative to the distance from the current price and your support levels. So since we're near a support zone right now, where there was past buyers coming into the market in the past at these levels, and we're in close proximity, we may even want to look through this week, and that's the nice thing about weekly options, is it gives us the flexibility to look at near-term data as markets are playing out in real time, but it also allows us to look further down the road if maybe our time horizon on a position is much further out than just this Friday. So if we look just out to Friday at the S&P options, and remember we've kind of identified this support zone down here, and we'll just kind of we can look at different strikes like 3,800, 3,850. I like to look at the century strikes, so that would be 3,800. The half century is 3,850, and then of course 3,900 being a higher century mark that we're in very close proximity to at the moment. To kind of look at what is the chance of the security touching that price. And then we're going to look at one other thing. What is the chance of that price being out of the money, meaning that the security we're analyzing, in this case the S&P, trades up higher than that particular price? So we're going to look at two things. We're going to look at probability of touching the price. So this can all be found in your options chain. Depending on your platform, you just may need to change your layout to see it. And we want to use probability out of the money. So as I've identified these levels, which is the first step, right? We need to find these visually on the chart and then relate them to the standard deviation moves using the Bollinger Band. We then want to look at probabilities as they relate to each other. So let's start at 3,800. It's the lower potential touch point this week. And if we look at the 3,800 strike, we can see that the S&P between now and Friday only has little under 29% chance of touching that price level in the next 3 trading days. And it has an 85% chance of finishing above that level. So it's important to look at these things ahead of time, because these are not static statistics, right? They evolve and change as the markets change. So I'll often jot these down on a piece of paper or take a screenshot, so that because it's difficult to go back and look at them in hindsight. And so I know if we do get down to 3,800, what these probabilities were previously telling me. And so if we end up touching 3,800, which is a relatively small chance, but not non-existent, and I find horizontal level of support on my chart at that level, I know that there's a high chance that we're going to finish above it. So that could be a reversal level, potentially. For confirmation, I want to see the actual security reject that level, and then buyers come in and push price higher. Same thing with 3850. So there's our half century mark, right? We have a pretty good chance of touching that, a greater than flip of the coin chance, 56% by Friday. And we've got, if that happens, we've got almost a 72% chance of trading above it. So this is still telling me it could be a good reversal area, right? The odds would be in my favor if I came in as a buyer on a touch, or particularly a reversal, because I'm not, an aggressive trader might trade, a probability of touch, but I actually want to wait for the confirmation to see buyers come in to the market and start pushing prices higher. I think that little extra patience pays off in the long run and gives you the added confirmation. But it's telling me that I have a good probability of success if I implement a bullish strategy with the expectation that if we do touch 3850 on the SPX, that the odds are in my favor that it's going to finish above that price by Friday. And then if we look at 3900, so this kind of completes our full support zone. We have a very high chance of touching that. And also, guys, look at the open interest. So these are the open contracts at these levels. So we haven't even looked at this yet, but we just visually mapped these levels on our charts, and we selected the century and half century marks. And if you look at the open interest at these levels, sorry, this is 2800, I crossed it, over 7,000 at the 3900 strike. See how much greater they are than all these other strikes in the chain. Not a coincidence. There's a lot of speculation going on around these century mark levels and even half century marks. So that's, it's not an arbiter.
You can see stuff correlated with like delta too. Looks like 0.2 delta's got 2,000. You got 0.25 around there, 1774.
Yeah.
Interesting. Like you said, they're watching these levels.
Yeah, they're not. So yeah, they're not. We don't select them arbitrarily. There's actually, a reason behind it, and that's one of them. But then if you start looking at the 3900 level, if we get a touch, am I going to want to trade that aggressively? If price comes down into 3900, we're obviously very close to it. But let's say, even though it might be a visual support level that we analyze on the chart, and we have a high probability of touching it, over 93%, our odds of finishing above that level are not much better than a flip of a coin. So if we get down there this week, I'm either going to want to, not jump on that, because I want much better than 50% chance of a coin, that if I'm going to take a long position in the asset, that it's going to have, the odds are going to be greatly in my favor of a reversal off that level. So here we don't have as great of a probability of that happening if we hit 3900. So these statistics, when you look at the probability of touching, and really you want to see in this, when we're using it to analyze a reversal, number one, you want to see the confluence between the analysis we did on the charts with the VIX, but also we want to see our probability out of the money if we're looking for a bullish reversal on the put side of the options chain. We want to see that significantly higher than the probability of touch. And generally, of course, that's going to be the case as you move further out of the money. So you don't want to just do it arbitrarily, and it should be done in the context of your chart analysis as well. But this kind of helps create a picture for us of where these types of opportunities in this case, the S&P, but again, can be applied to any optionable asset, can give us clues as to where selling may stall and reverse and buyers come in and drive prices higher. So it gives us a more complete picture of the other tools that we use, like our slingshot setup with the volatility bands, with Bollinger Bands, and our horizontal support and resistance analysis, and our 36 period monthly moving average, right? All of these things are really important. So again, 3,800, why did we also look at that, right? Because that was the dynamic support level of the 36 period moving average on the monthly chart, and often a very strong dynamic support level and turning point in the major indices. Again, it's very small chance we're going to close below 3,800 by Friday, but that's one expiration. So the other tool to add to this type of analysis is multi-expiration analysis. So rather than just look at one, we of course want to look at the one that might be relevant for the current markets. So generally I'll look at an expiration within the week that we're analyzing. But as an example, if we look back at the S&P chart, and let's say we get in a reversal off this 3850 support level. We see price come down into the 3850, and then buyers come in and push prices up. So we saw that back here again in May, a couple times. So as we see that occur, we want to then gauge, because volatility expands and contracts all the time in the markets, right? So if we're in the midst of a volatility expansion, and we know volatility is going to contract, the VIX is going to come back down, buyers are going to come in and push prices higher, our initial expectation is for that volatility to contract where it previously initiated. So again, that's going to be right up around where you see the volatility bands start to diverge, and you'll be looking right around at the 40-50 level roughly. So if we were to reverse around 3850, we've then got a couple hundred points, and this is just hypothetical because we haven't reversed off 3850, but just saying, if we come down into this support level, we do our probability analysis on the options. We've got our expected move back up into where the volatility expansion initiated. That can help us plan make a more informed plan around our trade. So when we're structuring a strategy around these expectations, we want to have some idea of the likelihood of this playing out and that reversal taking place, and then where is it likely to go? So then what we do with this information, so it's a 200-point move, right? So let's go back over. So I'm kind of going through this step by step in the process that I would do this, but we've got a 200-point potential move if there's a reversal off 3850. So we're just, again, doing this hypothetically as an example. All right, so if we see the reversal start to happen, we've got a 200-point move. We can look at our options chain, and we can look at, let's see here. So particularly if I'm going to structure an options trade around this analysis, I want to start looking at the expected move. And so that can be found over here on the right side of your chain. Again, maybe in a different location depending on your platform. But what I'm looking for, I've done my homework. I figured out, using the slingshot and the volatility expansion method, and then our support levels, and then probability analysis. I then want to look at expected move. So if I've got potentially a 200-point reversal potential to the upside, I'm going to start looking for expirations that have an expected move of 200 points, or roughly around there. So the options market is telling us that there's a potential for a 200-point move. So that's the expected move going out to September 28th. So that's how I'm going to use that information to plan my trade in my time horizon, right? So these expected moves are remarkably accurate over the long term. I think I've mentioned this in the past. They definitely fail in short periods where we get moves beyond the expected move. But this is key right here, particularly when we're in a volatility expansion and in particular a market sell-off. Usually when that's happening, we're exceeding expected moves. So that actually, because volatility eventually contracts, creates a greater likelihood that we're going to stay within an expected move in the future, because volatility can't remain permanently elevated. So that's good information to know. So then if I want to plan, a trade around a reversal off of a support level with the expectation the market's going to go back up, which of course it eventually will, it'll get to a low enough price where demand exceeds supply and buyers come in and push price back up. So if I want part of our trading plan, whether it's very short-term trading or medium-term trading or long-term investing, is to set a target, right? We need to have a goal in place once we enter a position, and ideally before we want to have that in place. So that's the other step in the process. So I've identified a potential 200-point move back to the upside on a reversal. How long should I plan to be in a bullish position if I decide to enter one? What expiration should I choose if I'm going to build an option strategy around it? Well, I need to look at the expected move. And that tells me September 28th. So what I'm going to do is I'm going to start looking at the September 28th expiration. Okay. And this is where you can start looking at the call side of the chain. So if price is moving up, S&P finds support, it reverses back to the upside. What are my chances between now and September 28th, where our expected move is plus or minus 205 points roughly, of reaching these projected profit target levels, right? So I want to start looking at things like probability of touch. So 40-50 is a long ways away, right? But interestingly, if you look at the 40-50 call strike, we've got a 50% chance of hitting that. And it's a long ways away at the same time the market's selling off and moving down. That's a really big clue. You would think when the market's tanking like it is right now, and it has been for several weeks, there's a volatility expansion, a lot of selling pressure, that a much higher reversal price wouldn't have a very high chance of touching, right? And when we looked at those at the lower prices on the put side, right, the probability of touch percentages were much lower. But in fact, I think, of course, we're looking at different expirations, but even 28 or 22 days from now, we have a 50% chance of touching that price. And this number will go up if the S&P reverses. Again, it's not a static number. So we want to use expected move and probability of touch. That's more important for a bullish trade if we're taking a long position, because that would be our initial profit target level. So we just want to see that if we're purely taking a directional trade, like buying shares, let's say, of the asset. We want to see what our chances of touching that level. But we can use levels along the way to set profit targets, as well as trailing stop levels, to manage our position along the way. So again, to do that, I focus on the century marks, the half century marks, and that's where you're going to tend to see higher levels of open interest. And you can look at the open interest too, across puts and calls to kind of make comparisons to see where there's more activity. We'll get into that probably in more detail in a future session. And then the other thing we've talked about is volatility skew. So we don't have enough time tonight to go back into that part of it, that piece of the puzzle and part of the trading plan, but definitely review the volatility skew, because that also, and we're going to talk more about that next week, because that's something that we needed to follow up on. And it's also a really important piece of the puzzle of using the options data to analyze probabilities and build a trading plan around it. But as we see major volatility skew, particularly if we're trading options, but even if you're just trading the asset and it's an optionable security, we can still use the information. But it will help us decide, does it make sense to sell, or short an options contract or buy it, or when setting up a spread, does it make sense? And so we're going to build on that more next week. But generally, you want to sell. You want to sell high implied volatility and buy low implied volatility. So if I wanted to, take a bullish, a bullish position on the call side on a reversal, there's a lot of, a volatility skew going on here, right? So as we move further out of the money, this is implied volatility, you're seeing implied volatility drop. So if I wanted to, let's say, buy a vertical spread, which is a directional bullish strategy on this reversal, where I'd be buying, just pick a random strike out of here, a higher strike, and then selling a strike at a higher price than the one that I'm buying, I need to look at the implied volatility, because that actually would not be a good strategy in the situation, because I would be buying high implied volatility and selling low implied volatility. That's what we don't want to do, right? We want to do the opposite. So we'll again get into using all of this information, these probabilities, and particularly volatility skew a little bit more next week. But that can help us also plan the type of strategy we're going to use, in addition to giving us clues of where turning points in an asset might be, and how far they might be likely to run, and what the time horizon that's likely to take place over, and all these things that give us, all this really valuable information in our planning process. So let's see. I'm going to pause there. Threw out a lot of information. See if there's any questions. We, kind of hit our time window here, but we'll probably hold off ticker roundtable for next week. But any questions, Richard, that we can answer before we close it out?
I was gonna say, Jeff, you're like an option scientist. Like, like we're in the business, we do this stuff, and we have to do a lot of multi-speaker events, and we have to do a lot of different things. We meet with people, and we go to the money show and the Traders Expo, and we speak to all these people, and nobody's teaching this stuff, guys. And if they are, it's not for free. So you guys are definitely in the right place. Again, if feel like it's a lot of information, and he gave us a lot, but if you kind of write down the key points of it, you'll see that it's really only 4 or 5 things specifically to do. And again, incorporating that with all the things we've been talking about lately should really help you craft a really consistent, reliable trading plan that not only weather the storm of what we're doing, capitalize on it, but have something long-term to play with. So I advise everyone to watch it again. If you have any other questions, I guess ask us later. I think everyone's just absorbing all the content. I'm sure we're going to get a lot of questions between now and next week. But
yeah, and that's why we record these as well, obviously. So because it is a lot of information, you can rewatch these right on our YouTube channel. Yeah. But yeah, let's keep an eye on this, on these levels this week, and then follow up on Tuesday, and see if we get the reversals that we talked about. And we can, I think it's important that as we're like talking about these things, we don't just leave them hanging. We need to come back and like we've been doing with the 36 period moving average and watch as they kind of play out. So last week we really emphasized as this volatility expansion was just starting, right? Last Tuesday, I told you guys expect a sell-off in the markets. So that's, has ensued. We're in the midst of it. And now I'm telling you, look at these probabilities, look at these support levels that we're spending, each week mapping out, and watch them for reversals. And then let's see where the market goes back up to. So I think it's important to follow through so you can really, not just learn it, but experience it, as the market plays out in real time. Yeah, again, these are the major ones to watch, I think, for this week. Again, we can look at, and we did to some degree down to into the 3,800 level, but I think it's unlikely that, we're going to get down below 3,800 this week. I think there's just too much support down here. But if the sell-off continues and we don't get the turnaround, more likely next week, we'd be looking at, the 3,700 to 3,750 century mark and half century mark support zone. So, but those are the ones that really keep an eye on for this week, right? And so just remember, we're in a volatility expansion right now to the downside, and then watch the VIX. If that, 29 to 30 zone on the VIX holds and we see VIX retreat back down and we see S&P move back up, that's our confirmation.
I got a follow-up actually on the strategy in a second. It's in the Q&A box. Marianne's asking, I'm confused about on the put side that you want probability of out the money greater than the probability of touch.
What you want to see is, let's see, that would be for a bullish, if you're a bullish expectation. So mainly we're looking at for the near-term expiration, because that would be because we're not in a position yet, right? At that point, we're purely looking at doing all the pre-analysis and looking at where we might get into a position as markets are selling off, and we would be looking at getting into a long position. So it probably is a bit confusing, Marianne, because you would think, when you're analyzing put options, we know those are used for, that would be, with the expectation if you bought a put, the stock's going to go down. But what it also tells us is that, if we look at the probability of that strike price being out of the money, because we're looking at a lower price than the current price. So like, let's say again, 3,800 on the S&P. We want to know what the probability is of that. So that's the probability out of the money of that strike being out of the money by the expiration date. So that would mean that the asset, in this case, the S&P, is trading above that level. So we want to see that. And again, it depends on what our strategy is, just to be clear. So when you're looking at the near-term expiration to plan the trade, so again, if we're just looking out to this Friday, we're at a support zone, and we're looking to get in to a long position off of a bullish reversal following a bearish volatility expansion or a sell-off. We want to see that reversal happen around one of these levels that has a higher probability chance of being out of the money. In other words, there's a greater chance that the S&P or whatever asset we're analyzing is going to finish higher than that price. So we'd want to use the put side, right, of the chain. And as I pointed out, the open interest often serves as, and you'll find that they coincide with a lot of these without even looking at open interest, which we didn't even do until we went over to the options chain, as actual levels of support and resistance. So when you see a lot of open interest at a particular strike on the put side, that can often signify strong support. On the call side, it would be resistance, because oftentimes, people are implementing covered call strategies. They might be long the stock and they're selling, calls at higher strikes for income on their underlying asset that they own. So that is often where people will set, or sell calls at a higher strike price. And you'll see a lot of open interest at these levels. So one thing you can do is you can use these visual horizontal and dynamic, so the static horizontal and the dynamic horizontal, which would be your moving averages, that coincide with these. We find those visually on the chart that coincide with these strike prices on the options chain. And again, you'll often see, you're ever wondering if the level you've picked out on your chart is significant, it can help to look at the open interest. But then we want to use probability of touch to start building our trading plan around it. So if we're in the midst of a market sell-off like we are right now, and we don't want to jump in late to the game, the sell-off's already happening, right? That's kind of what the bulk of traders and investors do. They buy when the market's at high levels and they sell when it's going down, and they get whipsawed and lose money, right? So the contrarian approach, and the way that professional money managers and things do it, is they look for buying opportunities in down markets, or they look for selling opportunities in markets that are overextended to the upside. So that's basically what we're doing. So we're then looking at the probability, if in the midst of a sell-off on the put side, of price touching a lower price level. So that's why we're looking at the put side, and we want to find that the strike price that we've analyzed, the probability of it touching that, and then the probability that, and again, it's a moving target. So as we look at this on a daily basis, as the markets are open and playing out, that they'll change. So we want to start taking note of what's happening with our probabilities around these levels. But we want to see, on a bullish position following a sell-off, a higher probability of that strike being out of the money as we start to, because we're really pre-planning here. We're doing this all way ahead of time before it's even played out. So for right now, if we do come down to these levels, and again, we're using the expected move along with that, we can know what our probability of success, or of touching a level, or of moving to a level with the expected move, all these things are, as we do like kind of cross expiration analysis, looking at the different expirations. So it's kind of a long answer, sorry, and I know it's a little complex, but that's why I want to follow up on this next week, because I think it might be a good opportunity for us to use this as an example, and then go back and look at what we talked about this week and how it plays out.
All right. I don't know if this is a quick answer or not, but David's asking, as long as the divergence cloud remains green on a move down, is there any implication that we may be approaching an exhaustion in selling? But I'm not sure if it's actually green right there.
Yeah, it looks like we're actually out of the green divergence cloud. Let me actually get over to.
I think it might be neutral.
Yeah, there's actually no cloud right now on the. There's no divergence right now on the S&P 500. You can see the cloud here is. So we came out of the green divergence, actually back here. So right now it's neutral. We don't have any divergence on the S&P 500.
Right.
But yeah, what we want to look for here again, and that's again, we've talked about the divergence tool in the past, but we want to look for, again, bullish divergence in combination with these other tools that we've talked about and all the other variables. So if we see bullish divergence start to form around these support levels and different probabilities that we've looked at tonight, that's more confluence of that we can build into our trading plan and make our decisions accordingly. So that's something also, if we get this volatility contraction and then a rotation higher off these support zones that we've mapped out this week, also we want to be looking at potential divergence opportunities as well. So we can cover that also next week in a little bit more detail.
All right, that's all I got.
All right. Well, sorry guys, we didn't get to ticker roundtable this week, but we'll spend more time again next week. It seems like we kind of alternate every week. Like we get kind of deeper into something and then, follow up on it, but then have more time the following week. So we'll do that next Tuesday. In the meantime, hope you guys have a great trading week. If you have any questions, you can email us support@altostrading.com.
Hey, Jeff, I forgot to bring this up.
Sure.
You can talk about what you're doing tomorrow.
Oh yeah, sorry. I'm glad you reminded me. So I'm actually I'm giving another talk tomorrow. I'm going to be going into some of our relative strength strategy tomorrow at, remind me, Richard, is it 3:15?
3:15 Eastern.
Yeah, so it's free. It's free to attend. It's just a 45-minute free class tomorrow. But I would urge you guys to register because it doesn't cost anything to attend. And also, if you end up not actually being able to attend live, you get the recording of it anyway. So Richard put that link in there for you guys if you want to go ahead and register for it. There are other speakers tomorrow too. I think there's like 5 or 6 of us. I'm going at the very end of the day. So great if you guys can attend live. If not, if you register, they'll send you the recording of it. And actually, I think you get the recording of everybody's talk. So there's like 5 or 6 really great speakers tomorrow. So the link is there in the chat. Yeah, thanks for reminding me about that. I almost completely forgot about it. So, all right. Well, thanks again, everybody. I hope you have a great rest of your week, and we'll see you next Tuesday.